Hello, from LPL Financial. Welcome to The Talking Point. I'm your host, Quincy Krosby.
Hello, everyone. This is Quincy Krosby. It's The Talking Point. It's March 6th, and it is about 9:30. The market is looking as if it's going to be in the green, but it's sort of jittery. The 10-year yield is down a tad below 4%. And as we've seen last week, as the 10-year yield inches below 4%, it helps the equity market. That's important because these psychological levels for the 10-year, I mean, really, what's the difference between 4% and 3.9%? But it does matter, at least in terms of the market's perception. The other thing I want to point out about last week is that the 10-year yield did come down. But in addition to that, we also had a couple of pretty good, and one was a wow, earnings reports, and that was Salesforce. Great guidance, top and bottom line. I mean, you can't ask for more. Was there margin compression? Because as everyone knows, there is a concern that we're going to get into a period where margins are compressed, operating margins are compressed. And yes, it did compress a tad, but nothing compared with, what the market is afraid of, that the operating margins compress, 10%. It was just a fraction of that. But overall, it was the kind of positive surprise that the market needed. The market needed to hear that a company is doing well and that it sees the future with the positive light. Similarly, on the retail side of things, Macy's came in, and that was actually pretty good. I wouldn't say it was, a wow out of the park, but it was good. And that's important because, again, there's that concern about retail and how retail is going to, how shall I say, navigate potentially a slower economy and a consumer that will slow down spending. So that was good. But also last week, Raphael Bostic, I do have a cold, so it's not your ears, it's me. Raphael Bostic, who is the president of the Atlanta Bank, the Atlanta Federal Reserve Bank, and a non-voting member this year, by the way, of the Federal Open Market Committee, actually came out and said that he was in the camp of the 25 basis points. In other words, he's not in that 50 basis point camp. He's in the 25 basis point camp. He thinks that's where the Fed should steer the market. Right now, by the way, as I do this call, and it's Monday morning, the 25 basis points from the futures market has it at 72% for March 22nd. The probability is 72% will be 25 basis points, and that means 28% is for 50 basis points. So much is going to depend on the data. It's extremely important. And speaking of data, just to wrap up last week, we got the report for the service sector. It was good, employment up, you name it, but prices were up also. Nothing compared with the prices paid component from the manufacturing report, but still elevated. And that's something that the Fed does watch. It's very important. He has mentioned services so many times. Ex-housing is the way he puts it. Now, this week is also extremely important, and we will have it by the end of the week a good sense of what the Fed is thinking. And how do we know we're going to have a good sense of it? Because we know everything that we look at in terms of the data, the market translates it into somehow the mind of the Federal Reserve and what they may do. Christopher Waller last week, though, I do want to report, he is a voting member this year. And he is a pragmatist. He tends to be hawkish. He basically said, look, we've got to be data dependent, and we've got to move in accordance with what the data actually tell us. And that, I think that basically sums it up for most of the Fed, the voting members of the Fed. They're not wedded to one or the other. They are basically saying, though, that if these numbers heat up, they may have to go to 50. So again, we'll see. And this week, they're going to have an opportunity. This week, above all else, Chairman of the Federal Reserve Powell is up on Capitol Hill for the semi-annual report to the Senate and to the House of Representatives. Now, where this gets interesting, and keep this in mind, you may say to me, well, Quincy, he reads the statement. It's the same statement, by the way, for both chambers. And then he gets into a discussion and questions and answers. However, I remember last year, he was able to move the market. And you know what did it? And how do we know what did it? Because we're watching it, and we're watching when the market actually moves up and ticks up. It was a comment that he made in the statement that said that the Fed is watching the economic ramifications of Fed policy. That moved the market. And the reason for that, and moved it way up, the reason for that was that everyone thought that the Fed basically didn't care, that they were basically on autopilot, so to speak, in raising rates, and were not going to pay attention to how the economy reacted to higher rate hikes, the rate hike regime. And when he said that, the market got, oh my goodness, this is great. This is great. They're paying attention, and that means that they may curtail the rate hike campaign. So that's how the market interpreted it. But anyway, so a sentence can move it, and also the way he answers questions. Also, I would suspect that in the House of Representatives, which gets a little bit noisier, by the way, than the Senate Q&A session, he may be pushed by some of the members on the Democratic side in terms of who is going to replace Lael Brainerd. The reason I'm mentioning this, and we may hear it tomorrow on the Senate side, is that Senator Warren from Massachusetts has come out and said that they want a replacement for Lael Brainerd, somebody who's not going to be in this camp of raising rates to get to the terminal rate. She wants someone who's going to be easier on rate hikes. This is the politicalization of the nomination and the committee that finds a replacement. So it's going to get very, very interesting, and I think you're going to hear this mainly on the House side. So that's going to be important. Remember, these are 2 days. He speaks to the Senate side first, and then the House side. And also, the statement he reads is the same for both chambers. Also this week, and today, this is factory numbers, factory orders down, okay, factory manufacturing down. We saw that. But what we're also going to have at the end of the week, and you know what that is, it's payrolls, and that's the big thing this week. But before we even get there, we're going to have the ADP report. And keep in mind, that's the private sector report that comes out on Wednesday. That does not equal what we'll hear from the government. How do I say this? If it moves up dramatically, with a very high number, the market's expecting actually maybe about 200,000 new jobs, but nothing dramatic. They always say that the payroll number, the actual one that we get on the Friday, sort of matches the trajectory, but it doesn't always work that way, and we have to remember that. But nonetheless, it does give us, a glimpse of how the ADP looks at the employment landscape. And again, they just do the private sector, and that's important. Also on Wednesday, we're going to have the JOLTS report. That's the job opening and labor turnover report. Why do we want to pay attention to this? Because what it will give us is a sense of how many jobs are open. And what the Fed would love to see, by the way, is to see that number come down and come down dramatically, because that would be their preferred way of trying to get wages to come down. Because after all, the fewer jobs you have, the pool of candidates for a position is narrowed, and therefore the candidate doesn't have that much leverage in terms of a higher wage coming into a new job. And then the beige book. And that beige book, typically no one ever really talks about it. However, I think it's important because it is an up-to-date report, more than most of the data releases that we get. It's an anecdotal report that's put out by the different banks, the Federal Reserve banks across the country. They speak to big business owners, small business owners. They speak to the banking banks that are in the different regions. They get a sense of lending, what's the view on inflation, and so on. And I think it provides a very interesting, again, anecdotal report on how different regions see the economy. One thing I want to add here is that the new head of the Federal Reserve Bank of Chicago, Goolsbee, who I believe worked for President Obama, he's a Democrat, of course, made a comment that he believes, and he's a very well-known economist, by the way. He said, I really think that the Fed should start looking at anecdotal information instead of just all of these, drafts, these reports that are written by the 400 PhDs that work in the Federal Reserve building in Washington, D.C. He said, we should hear from anecdotes. What do people have to say? Well, I'll mention this. The beige book, as boring as that sounds, because it sounds so beigey, actually does that. And I find it to be extremely interesting, and you get a very interesting snapshot of the country on some of the most important points that we're following and that the Fed is following. So that comes out at 2 o'clock on Wednesday. And then, of course, on Friday, we have the labor report. We'll be paying attention to wages, absolutely. We hope that wages have leveled off. We're going to pay attention to that. We'll pay attention to how many days is the average work week. And I'll tell you why that's important, because if you want to see if the economy is slowing down, you'll see it there because you'll have fewer days that people have worked. So that's why we plug that into our view of the economy. Also, we're going to pay attention to how many new people are coming in looking for jobs, and that's important, obviously. The unemployment rate stands at 3.4%. That is the consensus estimates that we stay there. And also the consensus estimate right now, and this comes before we see what the ADP report is on Wednesday, is 225,000 jobs added. And keep in mind, the market right now is not looking for a big wow number like we did before. 500,000, oh my goodness, that would not be cool, because that just puts the Fed like, we've got to slow down this economy. And we've got to do it somehow. And it wouldn't surprise me if you did get that wow number, as we did some months ago, that the probability for 50 basis points moves up. It wouldn't surprise me at all. The Fed does not want to see that. They want to see it slowing, not cratering, but slowing. So that's where we are. It's an important week for the market to look at data, because the Fed is data dependent. These are important data points. His speech is going to be important, the two speeches up on Capitol Hill. And I also want to mention that as I do this call right now, we were unhappy with the valuation on the S&P 500, the 12-month forward valuation at 18 times forward earnings. That's pretty rich. But when I say the word rich, I mean it's expensive. And what it tells us is that everything has to be going right to have an expensive market. And you don't want that, especially with all of the unknowns hovering over the market right now. So right now, though, it's at 17.5 times forward earnings. Still up there, but at least pulling back a bit. So again, what we're going to look for when these data releases come out, especially on Friday, is going to be what does the 10-year yield do and what does the 2-year yield do? Remember, you don't want them popping up anymore, because that then indicates that the market is expecting more inflation and that the Fed could continue. At some point, by the way, with the Treasury market, at some point, if the 10-year yield were to go up too much, it'll start coming back down. And the reason for that would be that the market then says, whoa, these higher rates are going to really hurt the economy, and therefore the yield starts coming down. So and then you'll always hear everyone saying the 10-year yield is telling us that there's a growth scare in the market if the 10-year yield comes down. All of these, we just watch all of these data releases and try to make sense of all of it. Let me get on to oil right now and the energy sector. There was disappointment in the Congress that's going on in China. It's the People's Congress. And the reason there was disappointment was that they said in their draft budget that they only expected sort of 5% for GDP. That's not what the market wanted to hear. That they did not want to see that was the target for the country. And especially not with the, qualified, well, maybe that's not what the market wanted. The market wanted a sense that the Chinese authorities really are going to help underpin the economy with stimulus to have it grow at a faster pace and at least a strong 5%. That's not what they got. It was interesting, and in addition to that, there was a sense from the commentary that the government has no thought about pushing a lot of fiscal stimulus into the system. One of the reasons for this, by the way, is that years and years ago, as China went through that mega growth spurt, double-digit growth, you could get so much cheap money, loans. A tremendous amount of leverage was built up, particularly in the property sector. Well, fast forward, and what you have is a property sector that is debt-laden. The companies are near bankruptcy or in bankruptcy. There are defaults. It's not a pretty picture. And they felt, even after the 2008, 2009, everyone thought that they would come in and push a lot of stimulus in the system. They haven't been doing that. The reason is they don't want to create, again, tremendous risk and tremendous leverage. They mention in some of these reports from this Congress the idea they want financial stability. They want risk brought down. And so, again, the market was disappointed that it doesn't look like you're going to get a tremendous amount of stimulus. Maybe the People's Bank of China will, they've already done it with some of the property companies by giving them special loans in order to keep them from going bankrupt. But overall, they are not going to go pushing cheap money, cheap credit into the system. They don't want to do that. However, they are seeing, again, a growth of a budget, not the GDP, but a budget of just over 5%, GDP around 5%. But they are raising the budget for the military, and that's really interesting. That's just over 7% hike in terms of money allocated for their military. And I don't need to go on this call. Everyone knows why. They are trying to build a powerhouse, military powerhouse, but they are going to need industrial metals. They're going to need silicon chips. So even though the notion that they're not going to spend a boatload of money for infrastructure spending anymore, and my goodness, they've got enough trains, they've got airports, they've got cities where no one lives. They went through that phase. They're going to need commodities for for this big push to build new systems, military systems. So nonetheless, I just wanted to report that because the market is paying very close attention to this Congress. It goes on for about another week and a half. That's the typical. It's typically 2 weeks long. So in any event, when that came out, oil prices pulled back, iron ore pulled back, copper pulled back. My view is not so fast because guess what? Again, They could have manufacturing keeps going. Jet fuel is needed. The tremendous amount of travel is scheduled in China, both going and coming. So it's hard to believe that suddenly, they're not going to be using any. We know from a number of the statistics that we receive that China is started to import oil more than most analysts have thought. Again, much of it comes from still Russia. And that's a whole other issue of how the authorities have got to monitor Russian oil, because it seems to be getting all over. And that was not the plan when the European Union, placed sanctions on it. So again, a busy week for the market. We're kind of finished with the earnings season. We had some very good surprises, especially ending the earnings season with Salesforce and a little bit out of Macy's. But overall, it was kind of a muddle through, and that's good news, especially given the predictions that it was going to be dire, with operating margins just absolutely under tremendous pressure. So take good care. We will be available and give us a call. But again, we're looking at paying close attention to those data releases and the effect that it has on the 2-year Treasury and on the 10-year Treasury. Have a very good week. We'll be back next week. Thank you so much.
This material was prepared by LPL Financial. It's for general information only and is not intended to provide specific advice or recommendations for any individual. There is no assurance that the views or strategies discussed are suitable for all investors or will yield positive outcomes. Investing involves risks, including possible loss of principal. Any economic forecast set forth in the podcast may not develop as predicted and are subject to change. References to markets, asset classes, and sectors are generally regarding the corresponding market index. All indexes are unmanaged and cannot be invested into directly. Index performance is not indicative of the performance of any investment and do not reflect fees, expenses, or sales charges. All performance reference is historical and is no guarantee of future results. All information referenced in the podcast is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Securities and advisory services offered through LPL Financial, a registered investment advisor and broker-dealer, member FINRA and SIPC. Insurance products are offered through LPL or its licensed affiliates. To the extent you are receiving investment advice from a separately registered independent investment advisor that is not an LPL affiliate, please note LPL makes no representation with respect to such entity. If your financial professional is located at a bank or credit union, please note that the bank or credit union is not registered as a broker-dealer or investment advisor. Registered representatives of LPL may also be employees of the bank or credit union. These products and services are being offered through LPL or its affiliates, which are separate entities from and not affiliates of the bank or credit union. Securities and insurance offered through LPL or its affiliates are not insured by the FDIC or NCUA or any other government agency, not bank or credit union guaranteed, not bank or credit union deposits or obligations, and may lose value.